Hey team, welcome to episode 151 of Transition Talk, where we talk about dental transitions and how to navigate the sometimes messy path to practice ownership. In practice transitions, deals don't happen without financing, but the lending landscape is constantly evolving and sometimes can be unpredictable. Both buyers and sellers are navigating new financial realities with various factors affecting both the market and practice purchase prices. One person who has to keep up with those shifting realities is Adam Schenck, Vice President of Business Development at Bank of America. Adam has a deep experience in the lending world and has played a role in several NDP deals. Not only that, but he is also no stranger to Transition Talk. He first debuted in episode 120, and we're excited to welcome him back. Adam, thank you for joining us today to provide us your expertise.
Thanks for having me. Happy to be back.
Absolutely. And not only do we have a guest, but we have the special of having both a guest and Mr. Loretto in the studio.
Yes.
Usually we do a solo interview, but today, Adam, you get both of us.
Well, I had to be here for Adam.
Of course.
As soon as I saw he was on the list, I was like, I got to be here. Don't leave me out.
So what's going on, sir?
Well, just normal
Life?
stuff. Yeah, happy to be here. I saw what we had on the docket today and looked at all our questions, and I'm kind of excited because, there's this thing of transition. I mean, the lending's a big part of it. It always is. And so let's start with a little weekend stuff. So what happened in your weekend?
My weekend, to jump in here, was wild. This is a summer for the ages for me. Busy at work, got kids graduating. I didn't know pre-K graduation was a thing, but my daughter had her first dance recital.
Ooh.
So, I saw a Broadway performance of I'm a Gummy Bear.
Oh.
And I've never been so thrilled in my life. It was amazing.
Very proud dad moment.
Adam,
It was. I'm on cloud nine.
You are in for just a treat if your daughter continues into dance, because Bryn is in dance and we're doing a dance competition in Nashville. So I get
Traveling
to go
dance.
Traveling
Oh,
dance.
my.
I get to spend 5 days in Nashville watching all the routines, all the flash, all the glitter. So I'm excited for what's to come for you.
Yeah, I'm
Adam,
excited for
how
what's in
long was
store.
this performance that we're talking about?
Oh, gosh. She did 3 songs in total. The whole recital was probably 8 songs, a few different groups, but her group participated in 3.
These are like 2 minutes.
Probably like minute and a half,
No,
too.
full song. So,
2, 3
she's
minutes?
3. So they did one that was an ensemble with the older girls as well.
Okay.
And then her group did 2 others, not solo, but just with their 3-year-old group.
Okay. Very impressive.
Yeah.
And you've got one that's traveling.
Yeah, this is the only one we travel. We've done
Okay.
4 competitions since March.
Okay.
So this is the final one. 5 dances, 5 costumes, 2 different colors of lip color, a hairstyle, makeup.
Oh, yeah.
I have to travel with this bag that I realize now I have to go through. I don't have to check a bag, which
Like
violates my no check policy unless we're going overseas.
A Netflix show about these crazy
I'm
Texas,
not a dance mom, by the way.
Texas moms that are traveling to Nashville. I feel like I'm going to see you on an episode
I'm
or something.
telling you, our last dance competition, we go behind the stage because we have to go into where they change, because they change behind the stage. And these other moms had taken our stuff and moved them.
Oh, yeah.
And then we're making horrible comments about the costumes and the hair and makeup of these children. I was like, you ladies are pathetic.
It's real.
This is horrible.
Yeah.
Do you have other things in life? Because this is just a dance competition.
So I have one daughter, and my daughter was, let's just say, the opposite of dance. But as parents, we're trying to just push our kids into all this crap. And, let's get her in dance. And so we pushed Bella into dance, and she said yes. And so you got to commit to it now. You said yes. But these recitals, I mean, for those that are listeners that have dance daughters, amazing. And I guess some dance sons as well. But these things are 8 hours long. And then you show up at 8 for a 2-minute version, and then another one at 1 for 2 minutes. And so when Bella just basically said, Mom and Dad, I don't want to do this, I was like, vote yes, we are done. I will allow you to check out early. We are good. It was exhausting.
I just feel like anything with your kids is like that. Some parents are like, oh, I want them to do this. And I'm like, if my kid's not into it, I'm out.
Yeah.
I don't want to get up to do soccer
True.
at 8 a.m. if my kid doesn't want to play soccer.
That's it. It is true.
I had one
Yeah.
that was no and one that's yes. And if you enjoy it, I'm happy to cheer you on.
That's a good point.
Otherwise, sleeping in.
For the record, even if my kid did enjoy this dance thing, I was out. Count me Charles, not a good dad, fine. But the dance, that was tough. That was tough to participate in. So sorry, honey, I didn't give you my all.
Bella will forgive you.
Yes.
Okay, so if we talk about lending, another little tough thing sometimes to accomplish, I'll start by saying I really appreciate you, Adam. You are always very educational, which is why you are back here on the podcast again, but not only in the podcast land, but also in just like day-to-day land. I think you do a great job of educating your clients and your potential clients about like, kind of what is expected and what to anticipate as they go through this process. And it's clearly changed. I think episode 120, I don't know, it's closer to COVID time. And that was a whole interesting hurdle. So tell us a little bit, like, what does the current lending landscape look like in practice transition world?
Yeah, it's competitive, which I think is great for doctors, clients, anybody looking to own. When it's competitive, lenders have to be innovative, right? We have to come up with new products, different offerings, ways to stand out. It helps drive rates down, right, to be as low as possible. But I think all of the competitiveness leads to a net win for clients, for doctors.
Yeah. And what types of trends are affecting the lending market? Like if you think about like what you're seeing today that maybe you didn't see last year, 2 years ago, or 6 months ago, maybe even.
Yeah, I think the trends are very region specific. Here in Dallas, we see a lot of startups, for example, a lot of people moving here, some areas where people can't build, right? It's oversaturated. Maybe transition's your only option. So I think there's still a lot of those trends that are geographic. The biggest trend that I hear come up is in regard to rates, right? And really, it's a situation that I think people need to take a breath and zoom out a little bit. We tend to be goldfish, have short-term memories here and think about the pandemic and where rates were at coming out of that. But really, when you look out, at a 5, 10, 15-year view, rates are amazing. In the moment, they are more volatile, right? Yeah. So big ups and downs week to week.
I actually had this moment. I started at NDP in 2014. And I recall rates being kind of where they are now in 2014, right? It was like 2014, 2015, they were kind of around this rate, and then they kind of went down, and then COVID, they went real down, and then they went up, and now they're kind of back. So it was like, look, same rates we were getting 12 years ago at this point, 13 years ago at this point. In the big scheme of things, they're still reasonable comparative to other types of loans that are out there.
Yeah, I was going to make a comment. First, Adam, I asked Christy when I saw the episode was coming up with you, and I said, well, didn't we just interview Adam like, I don't know, X months back? She's like, yeah, but Charles, he's so good. And he cares and does so much behind the scenes that others don't do. And it's something that I really appreciate. So just so you know, as a listener, when you choose a bank, if it's Bank of America or anybody else, you have to understand that the person you're choosing with is going to be that partner that is going to be with you post-close. And because the post-close, there are a lot of different things that sometimes that the buyer or the first-time person who's getting a loan is just not thinking about. They're not thinking about the requirements of the loan. They're not thinking about their next de novo start. They're not thinking about the building. There's a lot of things that perhaps they're not thinking about. So just kind of setting that up with you, when you win a loan in this very, very competitive environment, because I hear it all the time, price. You win that loan, and maybe it's sometimes not on the price, and maybe sometimes it is. What are things that you think that actually got you to win that loan? What are the things that you were able to say to that person who's borrowing their $500,000 or $1 million or $2 million for this practice that was able to basically persuade them from choosing you versus one of your competitors?
Yeah, great question. It varies case by case. The first thing I like to address with clients is thinking about the long-term plans, right? Lending is not a one-size-fits-all, right? And for me to sit here or look at a client on the front end and say I'm the right solution for them long-term is a disservice, right? Sometimes I am, sometimes I'm not. So first we need to evaluate what those goals are. Is it owning multiple locations? Is it owning just one location? Do they want to buy their building? So it's important to make sure that we have a long-term alignment with what they plan to do, right? Not just on the end state, but the path to get there, right? If they want to start 5 practices this year, that might not be something we want to do, right? So it's important to make sure you're aligned there. The other thing is in terms of the cost, a lot of people focus in on that rate. And it is arguably the most important factor. But when somebody is choosing their lender, they're choosing a 10, 15, sometimes longer relationship than that. And so it's important to understand what other fees and products and services are going to be offered, right? Is there a branch nearby? Do they require the credit card terminal? Those sorts of things.
Yeah. I find too that listening to the people that Christy and I get a chance to visit with, or on the Kane Waters side, I ask, how did you end up selecting? Or they'll just tell me. And sometimes it's a lot of communication, it's trust. They feel like they connected better with their individual person, which I find fascinating because sometimes people are just on that rate, which I try to just think beyond, ask those tough questions and be thinking about it from what's my future look like? And is this person and this bank going to be supportive for the fit for me? Because exactly, I would never encourage anyone to get that second practice off the ground until you have a full year and really understand how business one works before we start getting into business two.
Yeah, this is a common theme, but we talked about this in the last episode. We had more on the insurance focus, right? Like as a buyer, you have student loans, you now have this purchase loan that you're going to have to do. And so the rate and that price of that rate is always the biggest component. But I love what you said, Adam, about kind of what are the long-term plans, because I do think like prepayment, term, like what you have to do over the course of that loan, like what is the support post-loan? I think all those things are really important. And so you kind of have to think you're going to be a business owner. So you have to think about all the global picture of the loan you're going to get and kind of what that looks like and kind of what that experience has been. So I love that. If we think about sellers, right? So like that was kind of more buyer focused. I hear sellers say a lot like, oh, well, buyers can't get loans. Clearly, if you're doing like more of a 100% sale versus a partnership, but like, is there anything in particular, like sellers, if you're a seller listening to this, you should know about the lending market in kind of either of those scenarios?
Yeah, I mean, when it comes to sellers, the biggest thing is stability, right? Banks love when they see consistent financials, consistent year-over-year numbers. Does that mean increasing revenues is bad? Absolutely not. But banks love to see consistency. If we're looking at an opportunity and we see a supply expense that is all over the place year over year, that creates some concern. So the biggest thing is to just be aware of your numbers and do what you can to keep things consistent. The other thing I would say is cleanliness of the financials, right? Mm-hmm. The personal expenses being ran through the practice. That's another challenge that exists sometimes. And we find it's not a challenge as long as the seller's upfront with the broker or their representative. That way the bank's made aware.
Yeah.
So sellers, listen what he just said. Hammer down. Do not let the practice go from $1 million to $900 to $800. Keep the practice going. Secondly, really good, clean financial statements matter. And it is okay to run those discretionary things through the meals, the travel, the car, the entertainment, the kids, the profit sharing, all those things. But now you need a financial advisor, a CWA type person that can explain and work with the broker, the bank, so that this case bank has clean financial statements with explanations and bullets with exactly what took place. Even to that example of if the supplies were high in a certain area, specific breakdowns of they had a big implant order or they changed vendors, but it's already preparing for that bank for your buyer and for the broker, so we get the highest valuation. So short version there, hammer down, clean financials make a big difference, not just your financial advisor, in this case to the bank, which is going to be the buyer.
On the valuation topic, are you seeing any trends? We get a lot of questions about like, oh, well, what do you think's happening with practice purchase price? Are they trending up? Are they going down? Are DSOs making them higher? Are DSOs making them lower? Any trends you're seeing on the lending side from a purchase price?
Not much.
Yeah.
The honest truth is banks have limits to what they can lend, and practices fall within that range. Good practices tend to flirt with those upper ranges and push it. But as long as banks are where they're at, I think they're going to stay stable.
Yeah, I would agree. And I think if you're listening to, that's kind of what we've said on here as well, right? Which is a practice cash flows is what drive the valuation. And like if you're an orthodontic practice in Dallas, can you get more for it? Sure. Does that mean that a lender will lend it? Does that mean you will find a buyer that will pay it? Got to see the whole picture. But just like the housing market, there are certainly times where it's competitive and maybe something out of range you get for your practice, but that's not a guaranteed and it's still based on cash flow.
Yeah, I'm still seeing these high million plus collection practices with amazing overheads that are sub 55%, nice finish out. I'm still seeing brokers presenting kind of 100%, 80 to 100% of collections from a value standpoint. And I'm still seeing banks somehow getting that deal done. They may have a small requirement here or there, but for the most part, the ones that are making money, not just do we like it, but the banks in this case, like from your perspective, Adam, that those deals are getting done. One question I didn't see prepped on this, but I'd like to ask you, which I think is very interesting. When did you start at the bank? How long have you been with the bank?
11 years, 2015.
Okay. So if you can think about, do you remember the limit that the startup got when you first got in this business?
A GP startup, 550.
550. I am so old, I can remember when it was in the fours. Where is that now?
I believe it's 950.
$950,000.
Wowza.
Out of the gate. It's
Without
incredible.
$1 of income.
I would say you need a plan there.
Maybe.
Yeah, just a small,
someone?
small plan. So anyway, that is interesting to see. As far as things have changed in banking, wow, that is almost double the amount, well, at least double the amount, at least in my time frame that I've been here. So crazy.
I want to talk a little bit about specialties. I think the dental, whether it's perio, oral surgery, we'll talk about one in particular, understanding there are unique things, and we've talked about those the last time you were here, that you're going to look at for particular specialties to, again, assess the opportunity, assess the buyer, assess the practice. Orthodontics in particular has a little bit of a unique thing. We've run into this a few times. What is unique to the lending world when it comes to like an orthodontic practice? How do you look at those differently? What is the problems that you run into?
Yeah, the biggest difference is going to be production or lack thereof. Mm-hmm. With all other specialties and general dentists, production is tracked. So albeit it's not a perfect science, we can look at somebody's production and gauge their skill set, their hand speed, and really see how that stacks up to the seller, right? In orthodontics, that doesn't exist. Typically, you're dealing with per day rates. And so how does a bank look at that? What can we do? We have a baseline minimum, if you will, that we assume somebody can do. This is something we are constantly evaluating. Mm-hmm. We're about to update it as we speak, actually. So it's something that we're updating over time. And it really comes down to the client themselves having to go above and beyond to prove
what they can
their
do.
work.
Yeah. Mm-hmm. Yeah. And I would imagine that's harder when you have maybe a buyer who's worked in a practice with a lot of associates versus a buyer who's maybe been the primary orthodontist in an office and therefore can kind of attribute like all of this production is me versus like, here's the whole office and I work this number of days. So yeah, can totally understand how that's challenging. That's challenging even for us to say, hey, buyer, do you think you can handle this practice? They're like, well, I think. So there's a little bit of estimate. So I can understand how underwriters in a bank would look at that and be a little bit like, okay, is he or she going to be able to kind of maintain what's been done historically?
Correct. So we've had to look at days worked, hours worked, new cases, new starts to try to show how much production, if you will, an orthodontist can do. But that's the biggest challenge, especially if they're going to buy a larger practice.
In the end, the bank, they're looking at fail rates as well, right? And so if the bank is giving a resident with $1 million of residency and dental school debt, but yet we gave them $2 million to purchase a practice and it made $1 million and they didn't fail on the loan. This is part of the stats that the bank is looking at for future loans. Well, we have a 99.99% success rate with these orthodontists with not failing on the loan, and they're able to do this. And now we're watching they were able to keep up with that. So therefore, we're good. So you guys have a lot of statistics there that you can lean on. I think it's just fascinating that a resident that's basically been in a program for 27 to 36 months, that there's really nothing to track. There's not like we can see how many patients, what cases they did, but yet we're going to give them $2 million out of the gate. So it makes me smile thinking like, oh God, but in the end, it's a bank and they're looking at fail rates. And when the fail rate is so low to all these people, it obviously makes sense that you can afford to give $1 million on a startup with no patient. You can certainly give $2 million to an orthodontist that also equally has a very successful track record of not failing in this business.
Exactly.
Yeah. Why this business is so competitive is because it's so good, which I understand.
Let's talk about, you kind of mentioned residency kind of leads to the next program. Clearly, dental school, residency programs, increasing costs across the board, every college. Tuition is going up with all industries, but dentistry and specialties in particular. How do you see that impacting the ability to get a loan, the willingness to get a loan? Like kind of how does that impacting what you're seeing right now?
Yeah, almost no impact, believe it or not. So really it comes down to the monthly payment tied to that debt. So as long as there are income-based or income-driven repayment programs, that student loan debt typically is not prohibitive to getting a loan, right? So whether you have $200,000 or $600,000 of student loan debt, if you're on one of these income-based plans, your monthly payment is tied based into the cash flow of the practice. So when it comes to qualifying, helps.
Joanne, I think this literally needs to be, we interviewed Adam and Adam said the following. Okay, because this is something we have been preaching for years, and this is certainly to our sellers as well that are nervous about this buyer. No one's going to be able to afford, or bank's really going to be able to lend, but it's a no-brainer. And I look at it as a no-brainer, and certainly the banks see this as well. So it's good to hear. I got a question for you. What is the largest amount of like student loan debt you've ever seen?
I've seen 7 figures.
Yeah, you've seen over $1 million.
Over $1 million. I
just recently met a couple. They're graduating dental schools, no residency, just dental school. They have $1.5 million combined. They're going to get married. $750 each in dental school, and one's going to residency. It's insane to think that you could literally have a $2 million debt, and they were just absolutely freaking out about it. But in the same time, they're looking at, he's going to do, I think, a GPR program, but they're going to purchase like a $2.3 million practice, really low overhead in Illinois, and it's where she's from, and he's going to follow. And so they were worried. I'm like, don't be worried. Here's the cash. You're going to be making $1 million. Stop worrying about it. So yeah, interesting times to see where some of these student residents are coming out with this debt. So it's good. And these deals are getting done all day, every day with even those types of figures. So really good to hear.
Charles, you had a question, and we talked a little bit about you own a practice. You're going to buy maybe that second location. You want to do kind of a de novo, like kind of, what was your question? I know we talked about asking Adam some of those.
Well, I guess let me say it this way. I think people have this entrepreneur spirit in school, and then maybe it's like 20% of them, and they residency programs or schools that we teach at Christy, they're like, I want to own 5 practices. I want to own 10 practices. And to me, it just gives me anxiety thinking to try to run 10 plus practices. I'd rather own 1 or 2 and have them be multi-million. But I do think that we need to set expectations for these people. And I think, Adam, you can set expectations for them. The question would be is, if I purchase a practice and I'm telling you up front, I want to open perhaps 2 locations in the next 2 years, what would you say to me, and what would you do to prepare me that I would be able to fulfill that? Think about my business. Tell me I need to do the following. Kind of set me up for success there if I was going down those roads. And we'll assume I buy a small practice, and we'll assume I'm going to either do practice 2 purchase or de novo on practice number 2 and 3. How would you set my expectations for that?
Well, the first thing I would level set with you is the second practice is the hardest one to get, right? To buy or to start, because you're one person and you can only be one place, right? So to go from 1 to 2, a new factor enters that maybe didn't exist in this first one. We now need to account for an associate, right? So when it comes to buying a second location, generally we're looking at your first one like you wouldn't imagine, right? When you got your first practice, we didn't scrutinize your first one because you didn't have one, right? So we're looking at the performance of your first practice with a lot of scrutiny. We're going to be looking at its performance to just walk through a couple scenarios. If you come to us in a year and let's say you've collected $400,000 or $500,000 with your first practice, we're probably going to think you should spend your time growing that.
Agreed. Yes, thank you for saying that. Yes.
Before you overextend yourself. So that's the first thing, right? You had mentioned something before you had bought the smaller practice, but it's important to think about your first practice in terms of what future practices you want to own, right? If you want to own a second one after your first year, you should probably start with a bigger practice, right? It can be really tough to buy a bigger practice than your first one as a second location.
Let me give you a scenario because I think I know where you're going with this. So it's almost like I think I know what you, the bank, are looking for. And for the listener, so if I purchase a practice and it's a bigger practice, let's call it $1 million too, and after 1 year, I'm doing $2 million. Not only am I doing $2 million, it's got a really low overhead of 55% before paying an associate. I have an associate in the practice. I've got 60 to 70 new patients. Perhaps I'm in a limited space, call it a 4-chair practice, 5-chair practice, and I'm just executing 5 days a week, and it's magic. And I want to come over here, and I've done a good job saving, good clean financial statements. I've got a bunch of cash in the bank, and I come to you at 12 months. I got a tax return, and I say, Adam, here's my $2 million, here's all my cash, and here's the other location I want to buy down the street. It's $800,000 collection. They want a premium of $800,000. My guess is that you approve that person.
Correct. Yeah.
Right? And the 400 to 500 and less than $1 million that's trying to expand, do the de novo, my guess is you're going to say, you need to grow your practice. I love you. Thanks for the loan. I'm in the business of lending. I'd like to lend you more money because I get paid that way. The bank is successful that way. but you need to fix your first practice first. Are we on the same page?
Correct. Yeah. And you hit the nail on the head with something else there too. You said, I come to you with a tax return.
Yes.
Right. A lot of times people will buy a practice, today, and then fast forward January 1, they want to do something else, right? They want to buy another one. At that point, even if they do have a tax return, it's 6-7 months, right? So generally the bank's going to want to see a year of financials before looking at any future requests.
Yes. Financials is defined as the financial statements for the P&L for perhaps the full year, the year to date, and obviously at least that 1 year business return. So you could technically buy a practice and start in January, but you may not have a tax return in this example for about 18 months, the full year, as well as a good 6 months following. So just something for the entrepreneur, I want to own multiple practice location person to kind of level set. Is that what you said? Level set. I like level set. I'm going to use that in my family tonight. Level set. We need to level set how tonight's going to go down.
Well, and I also think, I appreciate what you're saying too, because I think that my question always is when I talk to someone and they're like, I want to have multiple locations. I'm always like, why? Like, tell me why you want to have multiple locations, because sometimes multiple locations is less profitable and more work and more risk, right? On you as an individual, and then clearly on a bank as well, because there's only so much of you to go around. And even if you have associates, that also can be risky, right? I don't know how a bank would look at that, but if I look at that, I'm like, so the only way this works is you find long-term associates that stay with you. But what if that associate leaves, right? Like what happens then, and what happens to that cash flow? What happens to that location? So I think that putting yourself, just be like the negative Nelly and like look at it and like what could go wrong and how is this going to look from a risk perspective. And I think if you can look at it like that, you'll probably have a very good idea of like what a bank would think or what someone like us would say if we were advising you. It's not wrong to want to buy and grow an empire, but you got to do it the smart way so that you can make as much money as you can, which I'm assuming is most of their goal at some point. So I think that's important.
Adam, I got another question. We talked about this a little early on where I'm the young buyer and I buy this practice and it's this $1 million practice and the price is $900,000. And I also, prior to closing, I'm sharing with you, hey man, I really want to buy the building as well. It's for sale. And the building price is $1 million. But I don't have this 20% down payment that conventional lending or even the 15% SBA requirement lending. I just don't have it. I have enough for the, call it $80,000 minimum that you require to get the loan for the practice, but I really want to buy the real estate as well. What would you advise the buyer that has that intent, that really wants to purchase the real estate, but for whatever reason can't qualify? So number one, what would you advise me to do? And two, what are some hurdles there that could actually get the deal done even with that little of a cash in the bank?
That's the first thing is we want to exhaust all options, right? We're going to look to see if there's any path forward that we have, whether it's conventional, whether it's SBA. And then we're going to look to possibly partner with another lender, right? Especially if there's no guarantee that that building's there for sale a year from now, right? So sometimes we'll do the practice and we partner with a lender for the real estate. Even in those scenarios, we can look to refinance that at a later date. So sometimes it's a means to an end. And then the absolute worst case scenario is just putting it on pause for a year, typically looking to come and finance it a year after closing.
Same thing, tax returns, P&Ls, show me you make money. Show me that you're saving more money. Show me that the rent is $8,000. Show me after we finance this, it's 8 or 9 or 10. It's a number. You're looking at that discrepancy and saying, you've got plenty of cash, at least from a requirement standpoint, you're good. And then we come back perhaps in that year standpoint, you got a little bit more liquidity and then it gives us more of an advantage to kind of relook at some of these other lending options. Is that accurate?
That's accurate.
Okay.
Yep. Okay. Most lenders are financing up to 100% on real estate, right? And there's a lot of metrics to that. So if it doesn't work on the front end, it's usually something that's easier to qualify for down the road.
Yep. And sometimes, correct me if I'm wrong, but if the practice itself is like 100% of collections, so the practice is 1 million collections and the price is 1 million, and I've got low liquidity, are you still saying that there is some options to get 100% lending?
Typically not in that scenario.
Okay. So the options around this would be as if we have that, perhaps I'm getting a good deal on a practice, right? So now the $1 million practice and perhaps is selling for $700,000, right?
Yep.
Now maybe the bank says, well, hey, would actually lend up to 85 or 90%. And so now there's almost, the way the bank is looking at this is maybe $150,000, $200,000 of kind of injection liquidity, and they're saying, we'll take a piece of that and put it to your real estate and then be able to get the deal done. Is that accurate as well?
Yep.
Okay.
Correct.
So the quick recap is if you get an amazing deal on a practice, there's a good chance we get the real estate. If we're paying a premium for a practice and you don't have the cash, we may be on the sidelines for about a year.
That's right.
Yeah. Well, if I ever fail at this job, it sounds like I got a job at the bank. So
yeah, there you go. There you go. And I think that that's an important consideration is like there's working capital, there's improvements to practices. Like, right, when we talk about what you get when you purchase a practice from a loan perspective, you have to account for all of the money that you need, not just the purchase price. So often we see people come to us and they say they're pre-approved and the bank's never looked at the actual practice financials.
Yep.
And I'm like, I'm glad you're in a good personal situation and that you have some, but like until we see practice financials, you cannot say you're approved. Or they are offering the max that a bank will give them. And then they're not accounting for like, well, how are you going to pay for anything when you first close? Yep. Or they say they don't want that money because they're worried about the interest rate. I'm sure you see this all the time. Like they want to as little as possible. And I'm like, well, you've never had a whole team who you can't make payroll. You've never had that happen. So I think that's an important thing to think about as we're talking about real estate and practice and the practice price and what proportion working capital has to be a part of that.
Absolutely.
I love working capital. I love buying AR. I mean, that's the best of both worlds.
Yeah, that's the same term as far as the purchase price. It's not like a separate loan. It's just part of your purchase price.
Correct. Yeah. Typically, you can look at working capital ARs or as even a line of credit, but working capital is included in the same loan. Fixed rate. It's better almost 10 times out of 10.
Yeah.
Well, I have a final question for you. As we wrap up today, I mean, I think what I've heard you say is the lending market is always kind of evolving and changing, and you guys are looking at things and kind of assessing each opportunity, and there'll always be a hurdle I think that both of us will look at, and a practice and opportunity will be like, oh, this is something we haven't seen before, and how do we solve that? And I think that that is why I love working with you. But the market itself has been stable, right? As far as kind of what we're seeing come through, the number of practice purchases, the practice purchase price. What advice would you give an associate, I'm assuming, maybe a student, but probably not, who's out there and knows practice purchase, ownership is in my future, next year, year after that, what are you telling them to do right now if they're calling you early and trying to make sure they have all their ducks in a row?
Yeah, I think the biggest thing is to focus on the right things. Everybody I speak with, they want to talk about rate and the price of the practice. Those are the only things they want to talk about. And those are important. We've talked a lot about those today. Just starting with the loan, right? The price of a practice. If we're talking about $100,000, that's a lot of money. There's no disputing that. But when you look at that in the form of a loan spread out over 10 or 15 years, that's probably about $800 a month. Okay, so that's less than $10,000 a year. And when you're buying a practice with $300,000, $400,000, $500,000 of cash flow, does it matter that you're only making $490 or $500? So for me, it's more about the doctors need to find the right practice, not the right price for the practice. I think that's the biggest message that I want to get across.
I love that because, that's what we're all about here. And I would second that too. Price is always going to be important. No one wants to downplay the importance and knowledge that you're about to take out this major loan. But we've also seen people who buy the wrong practice, who don't pay attention to the terms they agree to with the seller as far as their work back or all these components that really impact your life post-close more than that. In your example, $800 a month is going to impact them. So I love that. Any last thoughts before I sign us off, Mr.
This was
Loretto?
Amazing. Adam, you were such a good dude, and thanks for coming in and all your support you've given us for the years. And most importantly, the thing I love is the relationship, because I like it when we have a problem. The problem is that there's something going on behind the scenes with our client. You're able to be straight and tell us, hey, here's the other side of this. This is not going to work out. Appreciate you sending me this deal, but it's just not going to be for us. I like that. And I also like the fact that when there's a problem, you can kind of roll up your sleeves to try to figure out how to get them over that hurdle. I also appreciate setting the expectations out of the gate from the beginning. I think that's super important for our clients, both at NDP and Cane Water. So for that, all the little behind the scenes stuff that you do for us, certainly appreciate you doing the extra mile for us. So
thank you both. Yeah. Appreciate you having me on and letting me be a part of this.
Absolutely. Adam coming in with the education and expertise.
Yes,
That's
and dance stories.
And dance stories,
yeah.
I'm going to expect a dance routine next time. Father-daughter dances, they're coming. Don't you worry.
We'll see about that.
All right, team. That's all we have for today. Thanks for joining us on episode 151 of Transition Talk. As always, make sure to share the transition love with those who may not know of us yet. And of course, subscribe wherever you listen to your podcast. Until next time.
We'll see you guys.